we're above the congestion zone that preceded the bear, which is down lower. But, even price chart is saying, hey, I'm out of here. Why do you keep selling me? I've earned my way. It's not like I've had 10 months up. I've had 1 year of sideways, and now I've had, 2 months up out of that zone. I'm hardly old. By our metrics, you're not at least a bit overbought, and yet everybody's still claiming it's got to go down, but it's up 12.9% since the April close, whereas gold went sideways. What's going on here? Well, it indicates to us that silver and the gold and silver miners are shifting to outperform mode versus the mama metal. Yeah, gold's going to resume strongly, but they're going to outpace us on a percent basis. And I think a lot of that's going to occur between now and year end.
For over a decade, silver has played a secondary role. It followed, it lagged, it teased breakouts and then faded, but not this time. Michael Oliver, the technical mind behind momentum structural analysis, says what's happening now is unlike anything we've seen in years. Silver has broken above a price zone that's acted as a ceiling since the 2011 collapse. This isn't just a small win, it's the end of an era. That resistance zone defined the bear market. It's gone now. What's more, silver isn't rising in gold's shadow, it's taking the lead. Since April, silver prices have increased by nearly 13%. Gold barely moved. Mining stocks also outperforming. Oliver says this marks a significant inflection point. Silver and the miners are now leading the move. And that's rare. He points to the breakout from silver's upward trend channel, a structure that's defined its trajectory since the 2022 lows. That break isn't a technical glitch. It's what happens when momentum builds up and punches through, clean, sustained, and supported by fundamentals. Oliver says gold is in a pause phase. 3 months of sideways action following a monster 75% rally over the previous 15 months. Usually, such a move would be followed by a pullback as profit takers exit, but that hasn't happened. Instead, the market's holding its ground, consolidating. That's not bearish, that's loaded energy. If gold clears resistance at $3,450, Oliver believes we could see liftoff, and there's technical fuel behind it. But for now, the leadership baton has passed to silver. Bottom line, this isn't about catching a short-term bounce. It's about recognizing that the breakout already happened, and it didn't start with gold. Silver just flipped the script. The question is whether you're still reading the old one. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding.
Gold has gone dead sideways for 4 months. In fact, if you rotate active trading contracts, which is the way we plot our gold charts, in other words, we use August future up till you're into the last week of August, and it goes in July, and it goes into delivery. Like Friday, we're August 1st, so it's in delivery now. So we rotate to October gold. And you do a continuation chart, look at the April, May, June, and July close. And gold on a monthly closing basis has had 4 months of lateral, almost dead comatose sideways closes month to month, 4 months in a row. In fact, the close yesterday using the new active October gold was slightly higher than the prior 3.
Yeah, I've got the spot price.
Prior 4, excuse me. Yeah. So yesterday's close was actually a new high monthly close for gold. So everybody who's panicked about, gold it's topping, it's got to go down 3,000, 2,800, whatever. Okay, you've had your chance. You've sold into it for 4 solid months, now into a 5th. If you haven't made gains yet, you're not going to make them. This is not the way gold tops. When it goes lateral, like for instance, you have a little coil down there below, there was an example of 3 months sideways, and the 4th month said, heck, I'm out of here, okay? Now you've had 4 months sideways, maybe the 5th month says, hey, I'm out of here. And I suspect you get above your little coil top there, around 34.50, you're going to blow right through the roof. We've got momentum reasons to argue that, not merely price. Now, during that 4 months plus, the gold has gone comatose, happy sideways. Silver has gained, since its April close, as of yesterday's close, the end of the month, 12.9%, okay? Despite all the sell-offs, silver has gained 12.9% from the April close to the present, whereas gold's gone lateral, okay? And the miners have gone up big too since the April close. So what do you got here? You got the silver versus, yeah, there you go.
Yeah, spot.
I mean,
There's the April close around here. And
well, you can see some shelving action even on price. You've got one right there. Yeah, raise up a little bit. Yeah, right about there. Go down, right there. Yeah, go to the high closes in 2021. Yeah, and 20 up there, right there, those high closes, drop
Yeah.
down to the close. If you go lateral to the left, high close, not high trades, top of the candle, in other words, there you go, right about there. Look to your left and look what happened in 2011 and 12. You were butting up against what had been an attempted floor, okay?
Yeah, now
And
we're back, we're
restrained it.
above that now. Yeah.
Yeah. You fought your way above it after 2 years of congesting below it, 3 years. And look at the pullback since. You've had a couple of pullbacks that sat on that low. We're way above that level now. And frankly, we're above everything except the high month back in 2011. We're above the congestion zone that preceded the bear, which is down lower. But, even price chart is saying, hey, I'm out of here. Why do you keep selling me? I've earned my way. It's not like I've had 10 months up. I've had 1 year of sideways, and now I've had, 2 months up out of that zone. I'm hardly old. By our metrics, you're not at least a bit overbought. And yet everybody's still claiming it's got to go down, but it's up 12.9% since the April close, whereas gold went sideways. What's going on here? Well, it indicates to us that silver and the gold and silver miners are shifting to outperform mode versus the mama metal. Yeah, gold's going to resume strongly, but they're going to outpace us on a percent basis. And I think a lot of that's going to occur between now and year end. You can see, look at the number of rallies since that 104 level, which is about in the middle of all that ink of the last few years. That one right there in March closed at 104.21. We went long-term bearish on the dollar then. Now, we've had nice layered drops with sharp rallies. Just had another sharp rally. Well, it's sort of giving itself up a bit here. We think ultimately, you're not going to hold. This rally is just a counter trend rally, but it seems to impress everybody whenever the dollar rallies. But if you go back and look at the dollar and, for example, its relationship to gold, it is not a very good correlation. The dollar index, after all, is not a measure of dollar as an asset category. It's a measure of that asset category versus other fiat currencies. So it's one pile of this versus another pile of stuff, okay? In real dollar terms, it continues to decay in real value about, supply increases about 90% every 10 years.
Yeah.
So, its buying power gets almost cut in half every decade in terms of real, value.
Also, like the all-time low in March 2008 was 70.69.
Wouldn't shock me if you visit that.
Yeah, and at the time, gold just went up above 1,000 for the first time, and here we are around 100, and gold is 3,300 or 3,400. So yeah, over the long term, gold will go up against all the currencies.
Well, if you go back to the dollar index on a monthly, back to the 2015, for example, December of 2015, the price of the dollar then was about 97, 98 level in December of 2015. That happened to be when gold made its low, okay?
Yeah.
Okay, so we're at the same price level right now that we were a decade ago in the dollar, is what it says. Well, is gold at the same price level it was 10 years ago? No, it's more than tripled, okay? So the dollar effectively going sideways for a decade, you think, well, gold must have gone sideways. No, so it's the dollar index is merely a measure versus the euro and the yen primarily. And, so it's one piece of junk versus another, and I really don't quite know its value, except in global exchange. But in terms of holding value or pricing things, it's really illusory, okay? In fact, it causes deception in markets because people think, oh, my stock market went up nicely. If you go back to 2000, let's go back 25 years, for example, to July of 2000. And if you look at the S&P and where it was close of this July.
S&P.
It's 3.3 times where it was. It's more than tripled. Okay.
Yeah.
Gold is more than 11 folded in that same 25-year period. So, what holds its real value? S&P doesn't. And then when you measure it versus the decay in the dollar, it barely keeps up with it. Anyway.
Well, there you go.
I do think that the topping of the stock market, U.S. market now, and I think it's completing its top now. So again, a broadening pattern, is going to precipitate all kinds of panics and asset movements from here to there. And normally, when people move money out of the stock market, 2000, 2002, 2007, 2009, they move it into two categories, T-bonds and gold. T-bonds have not worked. They're dead comatose. It has not participated with gold as an alternative. Now, maybe it will. It's trying to rally today, but it's still, even its rally today puts it in the bottom clump of the last 2 years of action in the T.
The Fed pumps liquidity, slashes rates, markets soar, then crash. Rinse and repeat. It's been the same cycle for 100 years. But here's what's different now. People are finally catching on. Michael Oliver, a seasoned market analyst, says the pattern is so baked in that it's almost mechanical. Yet each time, the Fed acts like it's managing something new. The problem? The tools don't fix the system. They merely delay the inevitable and exacerbate the crash when it occurs. Currently, the Fed is deep into its so-called quantitative tightening phase, aiming to shrink its balance sheet and contain inflation. But that's just another version of the same game, tightening after overloosening. Earlier this week, the central bank held interest rates steady again, sticking to a wait-and-see stance they've clung to since January. Fed Chair Jerome Powell told reporters the labor market is still solid, which gives policymakers room to watch how Trump's sweeping tariffs ripple through the economy. But just 2 days later, labor data showed the job market isn't as strong as Powell claimed. So now we're watching the Fed stall while cracks widen. Oliver points to 2008. Most Americans weren't loading up on tech stocks or flipping homes with leverage, but they still got wrecked when the system collapsed. This time, the bubble's bigger. The exposure runs deeper. The average person may not own a hedge fund, but they're inside this machine through pensions, 401ks, real estate, even the purchasing power of their cash. Let's get back to the interview.
Already you've had academics, even some who favor the notion of a central bank, have been saying, especially over the last 6 months or so, hey, they're behind the curve. So even they don't like what's going on inside this Fed. So there's always this, even though they're on the side of the concept of the Fed, they don't like how it's running. Well, if all of a sudden you head down in the stock market in a big way, I don't mean you have to crash, and you get negative data points from hell, because we've got a bubble from hell, somebody's going to sit back and say, you know what, this has been going on for 100 years now since the Fed was created. And they create these monetary booms and busts, and where the money supply gooses, rates get artificially cut low, and the stock market follows, and then there's a bust and so forth. This isn't working. And so even though they may not have an answer, they realize this isn't what we thought it was. And you got to show the people your cup. It's really good.
Oh yeah, here we
Your
go.
coffee cup. And explain to them who that was and who that is there.
Yeah, that's Charles Lindbergh Sr., the father of Charles Lindbergh, the aviator. He was a congressman at the time the Federal Reserve Act was passed. And he said here, and I've got it on the other side, and I'll read it though. He said, this Federal Reserve Act establishes the most gigantic trust on earth. When the president, Woodrow Wilson, signs this bill, the invisible government of the monetary power will be legalized. The worst legislative crime of the ages is perpetrated by this banking and currency bill. I mean, that was pretty, he had it right on, I think.
It was dead on.
Dead on. I brought this up here, Michael, the Dow Gold ratio, because you said that the Fed came into existence and you started getting these booms and busts. And you can see this by the Dow Gold ratio. I mean, it's getting bigger and bigger. Do you also think, like I do, that we're going to go at least back down to 1-to-1 again?
Oh, can't predict that. All I can say is that the move has just begun in terms of the price dynamics, that likely the 10 years of arduous upside we've seen, but continuous upside in gold, silver, et cetera, is now going to go into a more vertical stance because the external technical and fundamental factors are starting to click into gear now, with like this week's action in the S&P, I think starts the process back down, which is not something the investing public expects. The data points go south in a big way. Central banks start pulling their hair. They get divided. Even the Fed is split. We got two. What happens if suddenly there's four? Powell's got to act pretty soon, because if he gets another bad monthly employment report or some other kind of data points that he likes to cite as being true and accurate, which is mistaken anyway, he's going to look political if he doesn't start cutting. He's going to look like he's game playing, especially if four voices pop up. But the question is, when things don't work and you go into a panic mode, and we remember 2007 to 9, the average American might not have been in the stock market, but boy, it hit them hard, family-wise, home-wise, mortgage payment-wise, et cetera. It was very painful. And this one is far bigger, this bubble. The errors compounded are far bigger. When they become exposed and you rip the Band-Aid off and people see what's there, and suddenly it's not just the stock market, it's now data points. It's I got laid off, my wife got laid off, we can't make our mortgage payments, our credit cards canceled, et cetera. I can't pay taxes, can't afford to, So suddenly all kinds of notions like the viability of the IRS as a source of government funding for government goes out the window, and they revert to sales tax. The intellectual support for the Fed goes out the window. Think in a minute, what Lindbergh said. By the way, somebody else said this. My son told me the other day he'd found this quote. Lenin even said, the way to destroy capitalism, there was a free economy, is to have fiat currencies and destroy the currency unit. That's the best way to destroy capitalism. He was dead right. And yet we did it anyway. We should have Lenin quote on the wall of the Federal Reserve building. But anyway, when you face a situation like that and emotion then rises, that's when concepts become doubtful. Questions of, was this really worth it? Is this valid? So forth. Give you an example. I'm an anarcho-capitalist philosopher. I wrote a book 50 years ago on it. But Javier Milei just got elected president a year ago in Argentina. It used to be the seventh biggest economy in the world. Now it's a backwater economy. Two parties have been rivaling for power there for decades and decades and turned it into a socialist, stagnant country. Okay, he won the election. He kicked their butts. It's like somebody running against Democrats and Republicans and busting them open. And apparently he's still popular, and he's started to cut major parts of the government out. I mean, literally cut them out, not just go, but a couple of people laid off or something. And one of the areas he sold off and got rid of was the government control over rents. Protect the people. We have to define rent prices and so forth and so on. Well, that actually created higher rent prices for the average Joe. Well, why did these people, especially young people in Argentina, who are living in a stagnant economy, hyperinflated, suddenly throw their hands up in the air and vote for a guy they didn't really understand his concepts, but he was a declared anarcho-capitalist. Nobody's ever declared, not just libertarian. But he says, ultimately, I want to get rid of the whole thing. We're going to do it in big chunks. And he got rid of that section. And all of a sudden, rental prices have come down to where people can afford it now. I even saw this covered and somewhat praised in a new Newsweek article online about 6 months ago, where they acknowledged that he had actually done this. That is what happens when upset occurs. People throw their hands up and say, I got to have something different. And I think that's about to happen here in terms of getting rid of stuff. And I think the stock market is partly an igniter for that situation.
Yeah, so that renovation of the Mariner Eccles building is going to be kind of a waste. Or could they turn the Fed building headquarters into a museum? Yeah. They turn it or in a hotel.
The history of statism. I don't know. But anyway, think about it another way, just the simplistic way. Soviet Union, back in the 70s, you'd see people lined up still getting bread from a bread store or getting meat from a meat store. And they'd be allocated, run by the government, supplies offered by the government, pricing determined by the government. So naturally, there were shortages. So what do we have? The most essential commodity between human beings in economic transactions, whether you know the person you're transacting with or you're buying a product from somebody in India that made it, okay, is the money unit. And if the money unit's a piece of garbage, well, then the transaction is questionable in terms of what are the rewards and gains. But you have a government monopoly over the production of and the pricing of the most essential commodity in human transactions. We don't have a monopoly over the production of and pricing of corn or hog prices, like they did in the Soviet Union, but we have it over money. And yet it's the most essential commodity that should be priced by market forces, not by some academicians. At some point, that institution could come into great doubt.
Michael Oliver breaks it down simply. The US dollar index isn't a real measure of strength. It's just a comparison against other declining currencies, such as the euro, the yen, and the pound. So when the dollar rallies, all it means is it's falling slightly less than everything else. But in real-world terms, purchasing power, what your money can buy, the dollar is getting shredded. Inflation and relentless money supply growth are eating it alive. Historically, the dollar's buying power has been halved roughly every 10 years. And no amount of FX gymnastics can hide that. Back in 2015, the dollar index index was sitting at 97 to 98. That's basically where it is right now. No big swings. On the surface, that appears to be stability. But here's the thing. In 2015, gold was under $1,100. Today, it's over $3,300. That's a 3x move. While the dollar index remained flat, gold tripled. That's not just outperformance, that's exposure. It shows that the dollar is a poor long-term store of value, even if it appears stable in isolation. Same story with the S&P 500. Yes, it's tripled since 2000. Sounds impressive, but gold? Up more than 11x in that same time frame. When you strip away the illusion created by a constantly devaluing dollar, the equity gains just don't hold up. This is Oliver's core point. If you measure wealth in a weakening currency, everything looks inflated: stocks, real estate, even wages. But that doesn't mean you're richer. It just means the measuring stick keeps shrinking. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.